My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people make friends. I'm just trying to help you make some money. My job is not just to entertain, but put collapses like today in some sort of context you can understand. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, let me get something that's kind of embarrassing at this moment. We like to kick these around the office every morning. Today, we're absolutely giddy about this market, speculating about how the Dow could give us a 14-day winning streak for the first time since the McKinley administration. And so many companies have reported great numbers last night that would see their stocks soar. Then, of course, the afternoon comes along. Interest rates spike viciously, and the whole market rolls over, with the Dow finishing down 237 points. No record there. The S&P tumbling 0.64%, and the Nasdaq losing 0.55%. The giddiness quickly subsided. Sell, sell, sell. It got real ugly at the end of the day with some awful reversals.
The House of Pain.
Now, it sure looks like our ebullience called the top this morning. Clearly way too much cockiness, always undisciplined and bad for business. Cockiness breeds arrogance, and arrogance breeds losses. But I don't want that to be your takeaway. Even though the average was down, I don't want it to be that. I want it to be something else. I don't want you to lose faith in this incredible bull market. Even when the market's on fire, stocks can still go down. That's just what happens. We can always get bad days, especially when they start as really good days and people are just too exuberant, and we had that happen today. However, I don't think this sell-off is the end of the world. To me, it feels a little bit more like a garden variety pullback rather than the kind of horrific declines we've grown accustomed to over the last couple of decades when the market looks really good. When you remember that a recession is no longer on the horizon, and that's what we have to believe, and many companies are doing incredibly well, buying stocks into weakness actually is rational. It makes perfect sense. Maybe not the first day, like today, but the market fell so hard from the top today. I got to tell you, I saw a bunch of things I wanted to buy at the end. See, there's something very different about this market, and that's the point I'm trying to make tonight. It's something that was with us for most of the time I spent at Goldman Sachs and my old hedge fund in the 1980s and 1990s. When I practically lived right down here, I could actually see the building I worked at. You know what we used to have? It was something called fun. Yeah, it was fun. I came down to Goldman in 1982, just when stocks started their historic multi-decade run. We didn't have CNBC back then, so we just kind of tried to figure out which stocks were most likely to outperform and talked about them all day. I rotated through various departments at Goldman, and we'd ban about hot stocks, which ones were going to hit a 52-week high, which ones would split. Yeah, split. Do you know something? We used to focus on that all the time. Which ones might get taken over during a period where there was no antitrust. There was nothing. This kind of sanguine chatter permeated the stock market for years and years. Even when the averages crashed for Black Monday in October 1987, falling more than 500 points in one day, which was a lot back then, stocks came right back. Sure, some smaller money managers got wiped out, but it was just a hiccup. The market quickly became fun again, because unlike what most thought, the 87 crash did not herald a recession, just more happy times. This positive attitude infused CNBC when it started in 1989. That made sense in the context of a fantastic bull market. Of course, there were always things that could knock the market down. Some earned phrase out of Washington, an insider trading scandal, a company that made up its numbers, the collapse of a takeover. But these were just speed bumps on the way to higher ground, because our companies kept getting better and better and growing ever faster with a super robust service economy supplanting our industrial sector as an emphasis for our nation. It was a time when the stock market was enjoyable. When U.S. companies ruled the world, you could make a fortune simply buying shares of the best ones and putting them away. Sure, we still cared about interest rates like we did today. The 20-year always seemed like around 7%. We sweated the Fed then. We sweat it now. We occasionally checked the overseas markets, but we were really the only game in town. We simply sat back and tried to figure out what was going to be the next winner, the next Pfizer, the next Merck, the next Intel, the next Microsoft. Hey, Intel, good numbers tonight. That's just the way it was. Until the late 1990s, when so many companies were doing well that picking winners, frankly, was like shooting fish in a barrel. And then the dot-com bubble inflated in 1999 and burst in 2000, wiping out a generation of investors who stuck with their favorite tech names on the way down and only decided it was just too dangerous to own stocks. It really hurt the asset class. The fun disappeared. couple years passed, and the market built up another head of steam. You know, investing got a little intriguing again. Otherwise, they'd never been giving me my own show in 2005 talk about stocks. Then the Great Recession came, and another major chunk of the population got burned out on stocks. The funds seemed permanently to disappear, replaced by negativity and endless fear and a notion that stocks were just a ridiculous thing to own. After that, for most of the decade, from 2010 to 2020, we got some rallies, but they were ephemeral, joyless affairs, usually punctuated by analysts and strategists and hedge fund managers who constantly come on air to tell you that stocks were overvalued, even as they did creep up. These guys always tried to make you feel like an idiot for owning individual stocks. They always pushed index funds instead and even questioned whether you should be in those. The conventional wisdom said everything else was just too risky. I think that's a lasting legacy of the dot-com implosion and the financial crisis. Stocks got some temporary lift again in 2020, but that was because the government started mailing people cash to help us cope with the pandemic, and new investors flooded the market. Then the party stopped again when the Federal Reserve took away the punch bowl at the end of 2021. Things only started feeling more heartening again in the last few months, as Wall Street recognized that we've been in a bull market since last fall. Of course, the fun and games ended today when interest rates spiked. I get that. That's not changed. Interest rates are always going to play havoc with stocks. We didn't break the Dow record. A lot of stocks that were flying in the morning got schmized later in the day. But I think it is time to recognize that something has changed with this market. And I think it's a change for the better. For the first time since the 1980s and the, let's say, early to mid-1990s, we have a lot of legitimate stocks belonging to many companies with amazing balance sheets and terrific prospects that are flat out doing very well. Sure, the Magnificent Seven are so big relative to everything else that it is tempting to only watch them. But there are tons of other excellent stocks belonging to companies with amazing stories to tell, including a couple I've got on tonight. We haven't had such a large percentage of high-quality stocks doing this well since the late 1980s and early 1990s. We were never punished for being giddy back then. People were just making a lot of money. That was an amazing recession-free period. We got something like that going on now with strong numbers coming out every day, even as the Fed tries to rein things in. So what does it mean that we can start taking polls about hot stocks or running pools about the Dow's winning streak? You know, not that much. I just think it means that we may be back in business as usual mode. Not back to pre-COVID, not pre-financial crisis, but back to the 80s and 90s, when stocks were really indeed so clearly the best asset class, and everything else just seemed like a waste of time, even if you got a decent return for cash. Of course, after the harsh sell-off this afternoon, you could argue we just called the top with our giddiness. You could say the bond market crashed the party because the economy's too strong. I don't know. But maybe, just maybe, there are enough companies with good sales and orders and gross margins that we can return to a period where owning stocks didn't make it feel like a pariah or a daredevil. Maybe it's because, like the old days, when we had the same kind of market where normal people used it regularly to save, make money, to retire with, to count on. Time will tell. And I know you can never say this time is different until you got definitive proof. But this move, this latest move, these last few months, since October, it doesn't feel like a rally to me. Rally implies something ephemeral. It feels more like a reasonable attempt to value stocks of great companies that are doing well in a world we've got lots of really good enterprises with amazing managements that are truly triumphing with real sales and earnings and not pumped up short-term numbers. Look, here's the bottom line. Stocks can still be dropped by a spike in rates like today, and there can be some big cap stocks that disappoint. But the joy, and I use that word carefully, but the joy we felt about stocks for so long, we had it for 2 decades before the century mark. Maybe, just maybe, we can have it again. Let's speak to Bob in Florida. Bob.
Jimmy Chill, this is Bob from Southwest Florida, calling from Creighton Cove. How you doing?
Bob, I'm hanging in. How about you?
Good, good. Hey, I'm a club member. I just want to thank you and Jeff for all you do. Your knowledge goes beyond.
How good? How about how great Jeff is? Jeff has got to do something else other than work.
Jeff is the best. But hey, quick booyah and bing bong. But hey, quick question. What about Lowe's? What do you think of Lowe's here with interest rates?
Well, I got to tell you, I mean, let me tell you what I feel about Lowe's. I think you got to take a long-term view about how Marvin Ellison's turning the stock around. I say long-term view because it hit its 52-week high today, and I've been liking the stock, but I'm loath to recommend a stock that added its 52-week high on a day like today when I know the companies could be vulnerable for a quick downturn if interest rates go up a little bit more. So I think you'd wait for a pullback, and then you can buy some. But I think what Marvin Ellison's doing at Lowe's is real, it's permanent, and it's great. Let's go to Fernando in New York. Fernando.
Booyah, Jim. How you doing?
I am doing fine, Fernando. How are you?
I'm doing wonderful. I got a stock here, Walmart. It's the world's largest retailer. It posted $611 billion in revenues last year. And with Piper Sandler upgrading Walmart from a neutral to an overweight, do you think it's a buy, even though it's close to its 52-week high?
Well, see, that's the problem. We had a reversal today, so why don't we let it come in a little more? I will tell you this. Sam's Club is doing incredibly well, which is why I think Walmart's doing incredibly well. So maybe you buy some tomorrow, but then give it some room. I like to do, like, I'll say a 5% scale. In the club, people know. I buy a little tomorrow and then let it come down and buy a little more. Because we are a little overbought, but I think that Walmart is a very good stock, and that is being driven by Sam's. Randy in Pennsylvania. Randy.
Yeah, booyah. The third time's a charm. You are the best.
Thank you.
Guess why? We're going back to the Super Bowl, and we're going to win.
Oh,
We're
yeah. Howie Roseman's got us playing another level. Yep.
We're going to win. We're going to win. I'm going to go with you. Well, coming from the Horsham Center. Sports Talk, we invite you to come. Investor Club, we just had Scott Palmer. We want you. You're going to come, Jim.
Thank you very much. Thank you.
Now, I sent you a gift. I hope you got a T-shirt. You have to wear it, the Freedom Fighters. You know what I'm talking about.
Yes, thank you.
Now, I want you to talk about Berkshire Hathaway Class B. I want your view on mid.
I want you to buy it. I want you to buy it. I just think that that pastiche of earnings is terrific. I think that there's a really good natural gas story brewing. The pipes are really in short supply. He's got a lot. The rails are turning around. I do think that the American Express position has gotten too depressed. There's so much that's good there that I always say you buy Berkshire big. All right, now there used to be a genuine feeling of joy towards owning stocks, one that hasn't been felt across this market for, well, let's say since the turn of the century. But we may be on the cusp of it again. I know it's not something you want to celebrate on a down day like today, but it does feel pretty different around here. Well, Mad Money tonight, going up. I'll see if that's what's happening with the stock of elevator maker Otis and if it's primed to do it with the company's top brass. Then we've got results from the 4 of the Magnificent 7, but which of these red-hot tech stocks do I think deserves the award for best so far this earnings season? I'm digging into details. And AGCO reported a big top and bottom line beat for the second quarter. So why did the shares sell off in response to earnings? Well, we got to get to the bottom of that, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.